Good day from CTP here in Prague, together with Richard Wilkinson. My name is Remon, and I am happy to share with you the results from 2022, the first 6 months. We've been busy, and I can report to you that the first 6 months have been extremely good. We have seen a fantastic rental income with high occupancy at around 95%. We've seen rental growth 4.3%, like for like, and the numbers will be presented to you in more detail by Richard Wilkinson. But in terms of rental income per year, we are now looking at 538 million euro of rent for a 12 months term. In particular, in the Czech Republic, we see high occupancy, 98%. Throughout the portfolio, it is currently 95%. So we continue to see strong demand, and this is why we have 1.4 million square meters of properties under construction. Most of those buildings are being built for existing tenants, mostly within existing business parks. And we do that as a good tradition at CTP within 10 years back. And that's what we say. That means 10% yield on cost. And then again, has been as always a challenge. Also our suppliers who continue to support us, the fact that we do have land which we bought at historically low prices with infrastructure which we share because we do those parks. But still, you need to still do it. Numbers don't lie. We did it again during the first half of 2022. So big thank you to all of the 620 boys and girls at CTP, 50-50 male-female, average 39. They get older as well, but they're still very eager and dynamic, hardworking bunch of people. One of the things I want to highlight, solar energy. We build parks, we have infrastructure in the parks with a local distribution network. So how easy is it for us to add solar on the rooftop, create energy and sell that within the park? And that's what we are doing. And we have been doing that, but we want to accelerate that. That means end of the year 40 megawatt, 40, end of next year 100, and we have a plan to roll out more than 300 megawatt of power. And that is also highly appreciated by our tenants, besides the fact that we make good money on that. Maybe give you a bit of a feel for the region of where we operate. 10 countries throughout Europe, from the North Sea to the Black Sea. Different countries, 4 core markets, Czechoslovakia, Hungary and Romania, where CTP continue to gain market share. But also we're very positive about the new markets, what we call growth markets, Bulgaria, Serbia and Poland. Western European markets, they perform beyond expectation, and I'm happy and proud of that. The Toyota deal in Vienna with 2 projects currently under construction in the capital of Austria. Quite nice, which we also built for very competitive rates per square meter. Netherlands going well, and excited about Germany. Of course, Poland, I want to talk about that more because we've been looking at that market for a long time. The largest economy in Central Europe, 40 million people along the German border. And we found the window, we found the opportunity to enter that market and buy more than 2.6 million square meters of land, zoned, serviced, ready for development. Strong demand from our existing tenants to go to Poland, to extend their activities, nearshoring, friendshoring, close by, where you can drive in and out from Germany, etc. Motivated workforce, the government in Poland support a lot these kind of initiatives. So we are excited about that opportunity. We bought land for average 70 euro per square meter with zoning, permitting, infrastructure. And we are building. We have 400,000 square meters under construction. We have a team of 30 people, 3 offices, Katowice, Poznan and Warsaw, of course. And very excited about that opportunity. At the same time, and maybe that is because of the German tenants we have with the acquisition of the Deutsche Industrie, very much like Poland for their growth as well. And so overall, throughout the region, strong demand, not just nearshoring or value add type of activities, but also inventory building, because of you want to make sure that you have a bit of extra stock, which supply chains have been proven to be not always reliable. It's more challenging to get product delivered from a bit further away. So nearshoring, inventory building, that all together with e-commerce. And the fact that, especially in Central Europe, we have seen an undersupply. If you look at the markets, then one of the characteristics is that there is just not a lot of space here, which we saw 20-something years ago, and we continue to build property, most of the properties being leased to our existing tenants. And when you talk about tenants, very loyal, long-term, of course, the largest logistics service providers in the world, DHL, Schenker, DSV, all of those great companies, privileged to work for, pay bills on time, all the time, but also grow, and we help them to grow, we grow with them. But also companies involved in manufacturing, and it can be all type of different companies like the Honeywells and the ABBs, but also companies involved in furniture making for IKEA. But we like to work for them all. And all of them create ecosystems in our parks. And our top 10 parks, I think, is 35% of our total lettable area. Large parks with lots of good for local communities, with nothing but long-term commitment and land. 20 million square meters of land. That's a lot of work still to build on those land plots, which will help us to grow and double the size of our company. Well, we have ambition for sure, and we have a lot of land. What else should we do with the land then? Build on it. I want to give the word to Richard, talk you through the very interesting part of the presentation, all about the financials, the cost of funding, and of course the rest of the year, and what has already been put in place for us to continue building this business with and for you. Thank you for your attention.
Thanks, Remon. We've delivered a strong performance in the first half of 2022, both operationally and financially. We generated a significant growth in our net rental income, up 32% to 211.5 million euros. And as Remon has said, we've seen strong like-for-like rental growth of 4.3%. This is driven by strong demand from our tenants, limited supply in our markets, and our focus on maximizing revenues. We're really pleased with the excellent revaluation result of 499 million euros in the first half. That's predominantly driven by the increase in rental levels that we are seeing in Central and Eastern European markets. And secondly, by the growth of our development activity. There's only a marginal impact from yield compression. Overall, this gives a significant increase in profit after tax to 490 million euros, reflecting the growth in rental income we see, our excellent revaluation result, but also our significantly lower financing costs. We increased our EPRA earnings by 37% to 126 million euros in the first half of 2022, and we increased our EPRA earnings per share by 20% to 30 cents. So we are on track to deliver our full year 2022 EPS target of 60 cents per share. We continue to grow the gross asset value of our investment portfolio. Together with the properties under development, this stands now at over 10.4 billion euros. That's an increase of 33% on a year ago. Our EPRA net tangible assets per share have increased by 11% to 13.39 euros. And we continue to deliver our highly profitable development pipeline. With a yield on cost of 10% for the 1.4 million square meters of properties that we had under development at the end of the first half of 2022. And we are financially robust. Our loan to value of 43.9% is comfortably in our range of 40 to 45. Our average cost of debt is only 1.15%, and the average maturity of our debt is just under 6 years. And with almost 1.4 billion euros of available liquidity to meet our future funding needs, we are very well positioned for the future. Finally, we're very pleased to announce today an interim dividend of 22 cents per share. This reflects our strong first half performance and the confidence we have in our very strong fundamentals. Let me quickly touch on some of those points in more detail for you. First, the consistently strong growth in our income streams. You can see here at the 30th of June this year our contracted income for the next 12 months is 538 million euros. That's a significant increase of 41% over last year's number. This is driven by a combination of the increase in rents on our standing portfolio, the significant progress on our development pipeline, and the acquisitions we've made over the last 12 months. And this gives us the confidence that our income will continue to grow. Put simply, we have a robust and growing income stream from our investment portfolio. And that rental income is underpinned by the strong demand from our tenants. In the first half of 2022, we leased a total of 935,000 square meters. Let's take a closer look at our revaluation gain of 499 million euros in the first half of this year. The key point to take here is that it's rental growth and our development activity that is driving the valuation gain. Over 300 million of this gain is driven by the increase in like-for-like rental levels, so the ERVs on our portfolio are increasing significantly. A further 114 million euros of the revaluation gain is driven by the progress in our development pipeline. So almost 90% of the revaluation gain is made up of these factors. There's only a marginal impact from yield compression. I want to finish by underscoring my earlier point about our financial strength. With a loan to value of 43.9%, we remain comfortably within our target leverage range. We have a staggered debt maturity profile with average debt maturity of 5.9 years and no significant repayments until Q4 of 2023. Our cost of debt is market-leading 1.15%, and 75% of our debt is unsecured following the issuance of our last bond in January. We have a very comfortable interest coverage ratio of 4.6 times, and all of our debt is fixed rate, so we are less exposed to the increase in interest rates we've just seen. We have a solid liquidity position. At the end of June, we had 630 million euros of cash available, and overall we have available liquidity of 1.4 billion euros. This all positions us very well for the future, even in a more uncertain environment. We continue to see strong ongoing demand from our tenants. That allowed us to grow our market share in our core markets in the last year. But we now expect to see attractive opportunities that we will look to capitalize on as and when they arise. Overall, this means that while being alert, aware, and agile, we remain confident that we will continue to drive our value creation strategy into the future. Thank you for your attention, and we look forward to your questions.